Hey guys, I know usually I don't cover content like this, but today I'm just gonna talk about SVB. Previously, I have no idea who the hell they are, but now I guess the entire world knows about it. The bank that collapsed this year. But that being said, I'm not gonna cover content like, whoa, is this gonna be the next financial crisis? Is this, the end of the economy as we know it? Alright, so that's not the scope of what I'm gonna talk about. But before I go into that, let's have a brief summary on what has happened to SVB in case you have no idea what has happened. So the story of SVB in short is that all the customers want to take out their money immediately and the bank has no money. Alright, just how much are we talking about? Looking at the financial statements before they collapse, you can see that, well, they have deposits of $173 billion. That is a huge amount of money. But how much cash do they have? They have only 13.8 billion in cash. Alright, so there's over 100 billion that they need to fork out, but they don't have the money. So if everybody wants to take out their money, the next thing that they can do, or which they have done, is to sell all of their securities to return the money to their customers. Then the problem about this is that if you look at the financials, well, it's going to be pretty technical. All right, so if you look at the assets that they have, the biggest that they have is actually this line. It's called a held to maturity security. These securities are usually bonds, all right, and they can be traded on the open market. So it's very liquid. They can get their cash back almost immediately if they want to. But the problem with this is that the fair value, or basically the market price of these bonds before they collapsed, was around $76 billion. But then they have over $91 billion in it. So what this means is that, think of it this way, you put in 91 billion, but you only have 76 billion left. That means you have a loss of $15 billion in there. So if you have read the news, they have to make fire sale on all these bonds and they have to basically eat in the loss. How much is 15 billion worth of loss? To put in the context, their equity before they collapsed was 16 billion. So if they eat a 15 billion loss, their equity is left with only a billion. Alright, that is like 90% of their value gone immediately just by selling the bonds. So there are two questions that we can ask over here. First question is that why do the bonds lose so much in value from 91 billion becomes 76 billion? And two, if the value is $76 billion, why do they record $91 billion in their balance sheets? Alright, let's explore that in today's video. Alright, to answer the first question on why the value of the bonds drop, we have to first understand how a bond works. Okay, so I don't invest in any bonds, so I'm just gonna pull an example from Google. Alright, so basically what are bonds? Bonds are basically like pieces of paper that governments or institutions they issue to investors. So this paper tells them how much is it worth, which is called the face value. It also tells them what is the interest rate that they are gonna pay, right? So $100 face value at 3.25% means $3.25 of interest, right? It also tells things like, who issued it, when was it issued, when is it mature, and things like that. Usually it's a pretty safe form of investment, especially when it's issued by the US government. So when these bonds are issued to the initial investor can actually sell it in the open market to other investors if the investor do not want to hold these bonds for whatever reason. The problem with that is that as with anything that is traded on the open market, it's subject to fluctuation in prices, like stocks, crypto, right? Bonds are same in that aspect as well. Usually bonds will only fluctuate if there are changes in the interest rates. And the problem with that, interest rates have been rising too much. With higher interest rate comes with lower bond prices. On that aspect is that it sounds pretty weird to me at first, because isn't it when interest rates are high, people will buy more bonds, so the price will be higher as well? Well, I did some Googling on that and it started to make sense, which I'm gonna explain right now. Now for that, we have to understand what is a bond yield. All right, a bond yield is basically the return of your bond. So that means is your interest received divided the price that you pay. To make sense on the effect of interest rate hikes on bond yields, we have to look at bonds in two types. One is a new bond, one is an existing bond. What you need to know that for every bond that is issued, the interest is usually fixed. All right. So if it's a 3% interest, then you'll receive $3 every year on a $100 coupon value. If it's a 5% interest on a $100 coupon, you get $5 every year. So with that, let's look at the impact of a new bond first. All right. Let's say, like, basically I've just shown you an example. All right. So if a bond is 3%, so you get a $3 interest on a $100 coupon value. If it's a 5% interest, so you get a 5% interest on that. Now imagine that you have a 3% bond with you. All right, so you'll continue to receive $3 until it eventually matures and you get back your principal. So now when with interest rate increase to 5%, say 5%, you'll get $5 of interest. All right, so the new one, yes, the new one, you will have 5%. But the existing one, when you kind of think of it, if both have the same coupon value of $100, which one would you invest? Would you invest in the 5% or would you invest in a 3%? Obviously, you're gonna go for the 5%. All right. With the same amount of principal, why not go for the 5%? All right. So what this means is that your existing bond at 3%, it loses its value. So this $100 will drop. All right. This $100 will drop to a value that people will accept. So what is that value? Imagine now interest is 5%. So basically the bond yield is now 5%. All right, so if you plug it into the formula, your bond yield is 5%. So your interest is still fixed, it's still $3. So if you play with the formula, you'll get a price of $60. What this means is that originally you have bought it for $100, now you only got $60. So you lose 40% just because interest rate has hiked. But this is just a theoretical example on why when interest rate goes up, your bond loses value. Even if you go to the charts, right, you can also see the relationship between the bond yield and the bond prices. Now in this case, I'm showing a 10-year treasury bond yield and the treasury bond price. If you look at this, you can see the inverse relationship, right? For example, if you look at here, lower yield, higher price. Higher yield, lower price. Right? Then here it just fluctuate sideways. Then higher interest, lower price. Okay, even though this bond, this 3% bond has made a loss of $40, the investor will only realize a $40 loss if he or she decide to sell the bond to the open market. But if the investor decided to hold it until maturity, they will still get back the $100, just that they have to hold for a long period of time. Bonds can have different maturity time frames, be it within a year or more than 5 years, 10 years, or even up to 30 years. Usually, if the investor has the holding power to hold it that long, this loss isn't really a loss, it's just a paper loss and it can just recover the principal after the end of the maturity. But in the case of our good friend SVB, if you look at the held to maturity securities of 91 billion, guess how long do these mature? All right, let's look at this table. Of course, there are a lot of breakdown, but I'm not gonna go through that. But basically, you can just assume they're all bonds and they work in the same way. All right. So you can see that within a year, only 69 million out of 91 billion. 1 to 5 years, 786 million, still very small. 5 to 10 years, getting bigger. Then basically you can see that 86 billion are more than 10 years. All right, more than 90%, more than 10 years. But the customers are asking for their money now. They need the money in like 10 days. In SVB's case, they have no choice that they have to sell all their bonds and realize that loss. All right, let's move on to the second question. If the cost is at $91 billion and the fair value is at 76 billion, why are the books recorded at 91 billion rather than the fair value of 76 billion. So for this case, it's a financial reporting issue. All right. So based on my understanding of financial reporting requirements, I would say that they didn't really do anything wrong with the financial reporting. Even the auditors certify that. So to understand that, we have to understand IFRS 9, or in the case of US SEC companies, ASC 320. Basically, for financial instruments, the standard says that there are a few ways that they can recognize the bonds or any other financial instrument for that matter. They can recognize it as amortized cost. You may be wondering what the hell is amortized cost. For the simplicity of this discussion, let's just assume it's cost. Ignore the word amortized. All right, this is a bit too advanced to explain it in a very short video. Other than amortized cost, they can also measure it at fair value. All right, which is in SVB case, the $76 billion in fair value. All right, and for fair value, there are two ways to recognize it as well, through other comprehensive income or OCI, or profit or loss. All right, this is also very advanced, so I'm not gonna touch it. Now, why did SVP recognize it as amortized cost? Because they met these two criteria. All right, so I'm just gonna read it as it is. So the asset, which is the bond, is held within a business model whose objective is to hold assets, keyword, in order to collect the contractual cash flow. In this case, it means to collect the interest. All right, and the contractual terms of the financial asset, basically the bonds, all right, say that, gives rise on specific days to cash flow. Basically, they know when they can collect the cash. All right, they are keyword solely for the payment of principal and interest. Basically, same thing. They can collect interest on the bond and they can collect the principal of the bond during maturity. So for the case for SVB bonds, all right, that is the intention when people buy into bonds. All right, people usually buy bonds to hold, to collect the interest and collect the principal at the end of maturity. That is the objective of a bond. So under this basis, there is in a way nothing wrong with what they are recognized in the books. Let's look at ASC 320. ASC 320 is pretty much the same thing, just different wording. All right, so you can see the word amortized cost here. You can see the word fair value, included in earnings. Basically, is fair value at comprehensive income, then fair value as well. All right, for the case of SVB bonds is here. So debt securities that have the positive intent and ability to hold to maturity are classified as held to maturity, reported amortized cost. Basically, same thing lah. All right, nothing wrong with the financial reporting requirement. But the thing is, nobody expects people to study just want to withdraw all their cash from the bank. Nobody expects that. All right, not the management, not the employees, not the auditors. Nobody can expect that to happen. Okay, so a quick recap on what we have learned in this video. SVB's collapse is because people suddenly want to take out their money and they have no cash. So they have to sell their bonds and realize those losses. Why do the bonds have losses? It's because at fixed interest payments and with higher interest rates, the prices are lower. So there's a loss over there. And did they do anything wrong with financial reporting? No, they didn't do anything wrong because when they first bought the bonds, it's their intention to hold until maturity. I hope this has been some sort of learning experience for you. Of course, not directly related to how we manage our money, but just a little bit more understanding on some finance and some financial reporting. But if you ask me what's my take on the implication of this collapse, I don't know. I'm just gonna follow what other people say. All right, and honestly, nobody can predict. All right, some people say, it will be the next financial crisis, and there are some people who say, nah, it's just a contained collapse. Ultimately, nobody will know what's gonna happen. When you come to think of it, who's gonna expect this bank to collapse? Nobody. So how are people gonna expect this to be the next financial crisis or not? All right, so we're just gonna play by ear and see how things develop. So with that, I will see you in the next video.